A boom is happening in real estate while most people are expecting it to crash. In this video, I'm gonna explain why that's happening, and hint, it's for a different reason than you would think. I'm gonna explain what you need to be watching and how you can participate in this housing boom without even having to buy a house. This is gonna let you get a piece of the action without taking a really big risk, without a big investment, so stay tuned. All right, welcome back to the channel. My name is Mark Moss. Thanks for coming by. I like to talk about making money. I like to talk about investing our money mostly and just having overall success in life. So if you like those types of topics, please click the like button, click the subscribe button. Now, if you've been watching this channel for any period of time, then you probably already know that I've been investing in real estate for a really long time. As a matter of fact, that's how I got started investing. That's how I started my investing career. About 25 years ago, I started buying bank repos after a massive market crash, fixing, flipping them, etc. Now, I've invested through multiple market cycles. Like I said, I started at the bottom of one of the worst ones. That was in 1995, through the 2000 crash, the 2008 crash, many booms and bust cycles. Now, even through all that, if you've heard my story in 2008, I got wiped out, had to rebuild it. But even through all that, real estate is still my main strategy. Now, I spend a lot of time investing into Bitcoin. I love Bitcoin, gold, lots of stocks. So I do a lot of that, but my end goal, all those profits always go to real estate, all right? And so because I talk a lot about real estate, because I have a lot of experience with real estate, I always get a lot of questions about the real estate market. Now, I've done several videos, but one of the things that I hear all the time, especially right now more than ever, from what I would say, quote unquote, would-be investors, is that house prices are just too high, right? We must be at the top because prices are so high. And they typically expect me to counter that or just kind of agree like, hey, how's your day? Good, right? Something like that. But usually I answer a question with a question. I'm like, too high? And I would say, what do you mean it's too high? It's too high relative to what? And when I say that, they're usually baffled. They're like, wait, what? I didn't expect that, right? So let me explain what I'm talking about. Now, all investing, or I should say even all value and investing, it's all relative. All right. Everything's relative. Everything that we do, we make choices relative to something else. So we make choices with our money every single day based off of relative value. So even if you're not thinking about it. So let me give you an example. So you're going to buy a car. Should you buy a Mercedes or should you buy a Toyota? Is the Toyota cheap or is the Toyota expensive? Well, compared to what? Relative to what, right? Similarly, you might go to the store and you might look at the name brand or the store brand, and you would compare and see if it's expensive or cheap relative to the other brand, right? And so with houses, with real estate, you might think that it's expensive. You might say, well, look how high real estate's up since 2012 at the bottom. Look how high it's up in the last year. Okay, great. So you might think that it's expensive, but I would say expensive relative to what? You see, most people are looking at it completely the wrong way. So I want to explain what I'm talking about so you can have a better understanding of this. Now, home prices might look high to you, like I said, and they are, right? The home prices are high. In fact, home prices, they're up. They're pretty big. In most cities, in my area down by the beach, they're going up like crazy, right? Just in the last couple of years, 30, 40% gains. The thing is, like I'm saying, is that's the wrong number. Because nobody cares about the price. Nobody cares about the price. What are you talking about? They don't care about the price of the house. What they care about is how much home can they afford? That's the question. You see, no one pays the price of the home. Yeah, they buy it for that price, but that's not what they're paying. They pay the monthly payment. Now, according to the report from the National Association of Realtors, in 2019, just last year, 86% of home purchases were financed, not paid cash, they were financed. An average loan to value of 88%. So 88% of the price of the home had a loan. Now, for first-time buyers, it was even higher. 94% of all purchases from first-time buyers was being financed. Of course, they didn't have money from another house, so they financed a little bit more. Now, when you're looking at home purchases, the very first thing that you would do, at least for the 94% of new home buyers and 88% of the others, the first thing you would do is you'd go meet with a lender, right? And you would find out, do I qualify for a loan? And really the question, so it's two questions. One, do I qualify for a loan? And second, how much home do I qualify for? right? So it's not like, hey, I want a $500,000 house. No, it's how much home can I afford? So that's the monthly payment, right? And it's the monthly payment as a percentage of your monthly income. Or, what's the monthly payment relative to my monthly income, right? So like I said, we make every single financial decision relative to something else. Now, if you didn't, you wouldn't know if prices were too high, if prices were too low, you wouldn't know, right? So let me give you another example. So with housing, let's say you're looking at a $250,000 house, $250,000, $250,000 house, and you're worried because the price of the house is really high. As a matter of fact, the price of the house is the highest that it's ever been, all right? But you like the house, you want to buy it, you're just afraid that the price is too high. So you would ask yourself, should I buy it right now? Because the price is high, I don't know. Well, in order to decide, we have to look at the monthly payment. And the payment is decided by one critical factor. Well, your credit score, that can change, but really it's driven by one critical factor, and that's interest rates. Okay. So today, 30-year mortgage rates are at the lowest they've ever been, record lows. They're sitting at around 3% interest. So basically what that means is that a payment on a $250,000 house, that $250,000 house, at a 3% interest rate is about $1,000 a month. Now, this is before taxes and insurance, so it's going to be up a little bit based off of what that is for you, depending on where you live. But relatively speaking, what if interest rates were at record highs? Now, like I said, they're at record lows, right? But what if they're at record highs? So what were record highs? If you're old enough to remember, I'm kind of old enough to remember, I wasn't buying stuff back then, but in October of 1981, interest rates on mortgages were about 19%. 19%. That's huge, right? 3% today, 19% back then. What does that mean? So on a $250,000 house back then, 81 at 19%, my monthly payment would be $4,000. That's a huge difference. I'm talking $4,000 back then or $1,000 today. So the question again is $250,000 cheap or is it expensive? Is it too high? Well, if interest rates were 19%, the price is way too high, right? I can't afford that. But if interest rates are low, like they are right now, if they're 3%, then you probably can afford that home. Does that make sense? Now, the price of the asset, the house, is unchanged, all right? It's the relative value of the asset that's changed, right? Its value relative to the interest rate. And the difference is incredible, obviously, right? From $1,000 to $4,000. Now, you see, what's driving the real estate market is not prices. It's affordability, which is the cost of the home, the monthly payment relative to your income. Now, the payment, like I said, is the key here, and low interest rates are the thing that affects that. So as long as your monthly payment compared to your income makes sense, then you would say the price of the home is cheap. Now, if we look at incomes, we look at home prices, we look at interest rates, we can see that relative, it's pretty cheap. So the National Association of Realtors calculates a housing affordability figure, and this measure hit 167 in the latest report. Now, what that means, 167, is that means that someone with a typical income can afford 167% of the typical home price in America. So if they could afford 100%, that'd be they can afford the price of the house. If they can afford 167%, they can afford a home and a half based off of their average income, the average price of the home, the average income. Now, that's data from last quarter because it takes a while to update, all right? And interest rates have fallen a lot since then, right? So that's what's pushing prices up. Interest rates fall down and prices go up. And so what that means is that affordability is on the rise because as rates go down, I can afford more home. Now, based on today's low rates, the housing affordability is as high as we've ever seen it, all right? Outside of the housing bust lows from a few years ago, like I said, like 2012, affordability is really, really high. So even though it looks like prices are high, affordability is actually really high. And this is what everybody is missing because you're not going to see this if you're just simply looking at the home price, right? If you're just going, it's $250,000, is that expensive or not? You're not going to see it. So we have to examine what the relative value it is, right? And when you look at the relative value, then the reality is pretty clear, right? This is an incredible tailwind for housing markets, right? So interest rates being so low is what's driving the market, even with all the other bad economic data, market data that we have, because people can afford homes, they're buying them, they're locking in those rates. And the thing is that, like I said, this is a tailwind. This is pushing the housing market because interest rates are down. Interest rates are way down. As a matter of fact, interest rates are going to continue down. As a matter of fact, I think interest rates are going to continue to go down, close to zero. We'll see banking rates in the US probably at negative pretty soon. I don't see interest rates going back up anytime soon at all. It can't. There's way too much debt, too much government debt. If interest rates go up, no one's going to be able to afford it. And I think they're going to continue to push interest rates down, to continue to hold rates down. And so that's going to continue to push the housing market higher and higher, at least for a long time, at least as kind of far out as we can see. And like I said, it's just going to keep making house prices affordable, which if house prices are affordable, then the prices keep going up. There's more to it though. And there's a really simple way you can profit from what's going on. So let me explain. All right. The reason I'm so bullish on housing, pretty simple. And I always break it down to the most simple thing, right? So whenever I'm talking about any of these assets, it always comes down to two things: supply and demand. All right. So in a bad housing market, supply overwhelms demand. Everybody wants to sell. There's not enough buyers. When that happens, prices fall, obviously, right? Way too many people trying to sell, not enough buying. But in the opposite situation, not enough homes and more buyers, home prices go up, all right? And we haven't seen the saturation levels yet. As a matter of fact, we're super far from it. Now, one way I see this is through the monthly home supply in the United States. Now, it measures how many months it would take to get rid of the current housing supply at the current sales rate. So, okay, at the rate homes are selling, how many do we have on the market? How long would it take to go through that? All right, this is a metric that everybody looks at. And in January, the monthly US home supply was 5 months, all right? Today, it hovers around 6. So as you can see from the chart that I have up on the screen, the supply, it's jumped up a little bit, all right? But it's nowhere near saturation levels. As a matter of fact, we've seen monthly home supply jump to double digits in the past. So 6 months, the current month supply, it's hovering right around about its long-term average. Now, this is a really positive factor for companies that build homes, all right? So it's going to be going into the next way we can profit from this. So it's really profitable for them. Supply remains in check. And this says that we're not going to see a flood of new supply anytime soon. Again, it's really good for them. So because housing starts are down so far down dramatically since, the whole CV virus, the pandemic outbreak began, they're actually down about 45% since the January peak. And they've fallen, all the way down to recession, depression levels. So I think we're about to have a severe shortage of new homes. Again, supply and demand. What does that do? So, of course, the CV pandemic is slowing the demand a little bit. And a lot of people, are thinking about selling their homes. And I've done other videos about that. But really, this just comes down to supply and demand. Supply and demand is such a powerful force. You can't overlook it. And we have supply down so much that home builders are in a pretty good spot. Home builders don't have a lot of supply in the market. There's a lot of demand. Now, I was pretty bullish on some of the home builders. And in my private group, we actually got into some of these home builders and we were riding them up. And I felt really positive about it before the pandemic hit. Of course, when the pandemic hit, the entire stock market collapsed, took them with it. As a matter of fact, the home builders fell about 50%, 51% from the peak, all right? From where they were all the way down to the bottom in about February and March, just like everything else, right? But the sector of the heart of the housing boom basically lost half its value in a month, right? Crazy. Now, if you owned any of those home builders like I did, like we did in our group, then we took a hit. We took a small loss. However, it was a small loss. Thank you. That's why we use stop losses. If you don't use stop losses, you need to, because you never know what can happen. But the rally in recent weeks has been just as powerful. So just as fast as it fell, it's been rallying back up. And as a matter of fact, the home building sector is up about 80% from its recent lows. If you got back in, you're doing pretty good. Now, if you combine that with the fantastic, again, relative value in housing, as well as the supply and demand positives, makes one thing pretty clear. Housing, I think, is a good bet. It's a smart bet today. It's a smart bet moving forward in the future. And I think owning the home builders, the companies that drive the housing market, is also a smart bet. It's a way that you can take advantage of this market without having to make a huge investment in a house, without being stuck in a house. So you can take advantage of the price, but you have liquidity, you can get out, you can use stop losses and all those things. So what do you think about housing? Do you think that those factors I'm talking about are going to push prices higher? Supply and demand is low, interest rates are low and falling. Will that be enough to push the prices up, or is the pandemic going to push the prices down? Leave me a comment and let me know what you think. I always love to hear from you, and I love to have conversations back and forth. If you like the video, give me some thumbs up on the video. If you don't like the video, that's okay. Give me thumbs down, but let me know either way. I always want to hear from you, and that's all I got. To your success. I'm out.